So with the market close yesterday, the S&P 500 was up about 18.1% year to date. We come into the office this morning, the markets are trading sideways, and then we have some retaliatory remarks coming from China on U.S.-China trade, and then we get the big news today. President Trump is tweeting again, and he has ordered the immediately American businesses start looking for an alternative to China. So Trump orders American business to exit China today with his tweets that have been all over the news. Everything is in the red. S&P 500 falls over 2.5% today, knocking our year-to-date returns back down to about 15.5%. Treasuries rally sharply on the fear trade and flight to quality. Oil down 1.5 to $53.5 for West Texas Intermediate. On global growth concerns all over again, the flight to quality trade, gold and silver, were up about 2% as gold seems anchored above 1530 thereabouts today. So I'm Jack.
And I'm Bill.
And welcome to the Jack and Bill Show. So Bill, you know, this is one of the key risks that we've talked about in the markets this year has been headline risk, which is what we're getting with all these tweets. And, you know, I'm just wondering, with an election coming up this year, what is Trump thinking? Is this some kind of head fake? Is this China trade thing over with?
I don't know about head fake, but I am not about to try to put myself into the head of Donald Trump. I think that'd be unwise for anyone to do, frankly. But if you think about what got us here today, you know, as you said, the markets were fairly stable this morning until there was an announcement by China of their intention of placing 5 to 10% tariffs on $75 billion worth of U.S. goods. And in response to that, the president tweeted. It does seem like we're living in a bizarro world when the president of the United States orders U.S. companies to find new trading partners, move their business from one country to another. Well, first of all, I mean, that's not even legal. I mean, we all have been conditioned by now to know that the president says inflammatory things that are not always true. Okay, we all get that.
And we're going to trade where we get the most bang for the buck.
Absolutely. But it's unrealistic to think that we can just uproot manufacturing bases and move them back home or elsewhere outside of China. It took us decades to get where we are, and multinational corporations, including U.S. multinationals, have these global supply chains in place. They've been in place. Like take, for example, an auto manufacturer, General Motors. Okay, they're selling a car that may be assembled in the United States, may not be, but even the car that is assembled in the United States contains much foreign content. It could have an engine that's built in Mexico. It could have electrical parts manufactured in China, all over the world. And you can't just disrupt these supply chains overnight and replace them with something else. It's just not viable, Jack.
Yeah, I agree with that. Well, consider this. You know, we did have a tweet this morning that that raised the possibility that Jerome Powell, head of the U.S. Federal Reserve, could be a bigger enemy than China. So, you know, with that, the Federal Open Market Committee meets next on September the 18th, I think. And I think Trump's trying to get them to give us a 0.5% rate cut. He's been very critical the last few weeks, saying that they've tightened way too much and shouldn't have been doing that. And, you know, that thwarts U.S. economic growth and global growth. So what if what if we get a 0.5% trade and then Mr. Art of the Deal becomes a hero and works out some kind of trade deal with China, and GDP growth keeps going 2 to 3%, and President Trump gets reelected. Maybe that's what's in the plans here.
It's very possible. I do want to point out a couple things. One, there are many in the Federal Reserve Bank who are advocating for neutral to tightening monetary policy, meaning they would rather see short-term interest rates stay where they are and even go higher. And the reason for that is our economy is relatively strong right now. And one metric that they're looking to is the low unemployment. We're basically at full employment in this country. So it does make it a little more difficult to justify loosening monetary policy at this time. So what happens if we do actually go into recession? That's one tool that's not left in the toolbox. But to the president's point, and he raises a very valid point here, we are less competitive globally because of our higher relative interest rates. So elsewhere around the world, in Europe and Asia, they are lowering interest rates very aggressively, and their interest rates are much lower than ours, so it makes us less competitive. And the higher interest rates in the U.S. dollar higher interest rates in the U.S. prop up the value of the U.S. dollar relative to foreign currencies. So it does make U.S. goods and services less competitive in the global marketplace.
Yeah, that's right. And, with this huge flight to quality today, though, Bill, and talking about interest rates going lower, we just penned a piece this week that will soon be on our website, our August market commentary. It's entitled Stocks for Income, Bonds for Speculation. Say what? So if you just to get into that a little bit, there's been a lot of talk that we write about in here called inversion with the yield curve. And most economists would define inversion as when the 2-year Treasury note yield exceeds that of the 10-year Treasury note yield. And we first encountered that last week on the 3% down day. I think it was last Monday. Anyway, we got there again today. The 2-year note yield is 1.54%. The 10-year is 1.52%. So you make more interest on a 2-year note than a 10-year note. What's significant about this is the last 5 times this has occurred since 1980, within the next 6 to 18 months, the U.S. has entered into a recession. So the bond market is kind of telling Jerome Powell and his cronies, you need to lower short-term interest rates. The bond market has kind of been doing it for them. But we've noted the bigger story here about the bond market is not this inverted yield curve. It's the magnitude of the decline that we've had in rates from 0 to 30. I mean, all the way down globally. And in the United States, for example, let's just say you wanted to put your money in U.S. government guaranteed treasuries backed by the full faith, credit, and taxing power of our United States Treasury. So last November the 15th, you bought the current issue 3 3/8% coupon due November the 15th of 2048, or 30 years from there. Here we are, not even 9.5 months later. You would have spent, if you bought 10,000, they're sold in $5,000 increments generally. Actually, treasuries in $1,000 increments. If you bought $10,000 worth, you'd spend $10,000. If you want to buy that same bond today, it would cost you $13,000. Or the dollar price has gone from 100% of par to 130% of par. In other words, in the last 9.5 months, an investment in our long bond has appreciated over 30% and paid 3 3/8% interest the whole way. So that's where we're getting. But that is a speculative investment today, because what happens if rates go the other way? And that's something that we've written about in this piece. What do you think of that?
Yeah, there is no reason for anyone to invest in a 30-year Treasury bond yielding 2% a year unless they're speculating that interest rates are going even lower in the future. And the premise behind that would be economic trouble down the road. Now, there are exceptions to that, like institutions like insurance companies, but the speculation is what's driving the interest or demand for these long-dated bonds with very low yields. This is not a good time for investors who are dependent on fixed income securities. It's very hard for them right now. The only one benefiting from this very low interest rate environment are the borrowers. Now think about this. The U.S. government issuing 30-year bonds paying 2% a year. Well, it benefits the U.S. government because the U.S. government is running trillion-dollar deficits. We have this massive debt burden as it is. We could not afford to service our debt burden at normal levels of interest. If interest rates were to normalize and get back to levels where they were, say, 20 years ago, 15 years ago, just servicing the debt alone and entitlements combined would crowd out everything else. We'd have very little, well, we would not have anything left over for discretionary spending. Hopefully we could fund our national defense requirements. But that's the state that we're in right now. So it seems like it's becoming the vogue thing for governments around the world that are struggling financially to race to the bottom with interest rates to continue fueling budget deficits.
Yeah, that's right. And in our piece entitled Stocks for Income, Bonds for Speculation, we thought we'd talk a little bit about the risks of trying to jump into this party late and capture some of these incremental returns from the bond market. They are government guaranteed bonds, but that's if you hold your investment to maturity. And we have no idea what the credit, a U.S. Treasury credit, will be like in 30 years. But we mentioned the mathematics behind the bond market in here with a concept called not maturity, but duration. Duration is the time-weighted average of all the cash flows of a bond. So let's get back to that 30-year U.S. Treasury bond today. It actually has a duration of about 23. 23 is a number, that means years. That's a time-weighted average of 23 years to get the 60 different coupon payments paid semi-annually, and then the final maturity with the last interest payment. So another way to look at that might be more useful is that same duration number that's a mathematical computation using differential calculus. You get the number 23. If interest rates at that yield level climb 1%, that bond would decline in value by 23%. So Bill, imagine if we buy the long bond. I think it closed to yield about 2.04% today. It got down to 1.97 last week. These are the lowest levels ever in U.S. history. So you buy that thing today to get 2.04, or call it 2%, is 50 times earnings, with the stock market selling at 17 times earnings. And then yields go to 5%. I remember in 1994, the long bond was at 5.78%. Within 90 days, it got to 8.25%. Though the owners of those long-dated bonds got hammered. So, you go from 2% to 5%, your investment is worth less than half of what you started with.
You know what they'd say in Brooklyn about that?
What's that?
Forget about it.
That's what I say, forget about it. So what should we be looking to do then, William?
Well, this is a theme that we have spoken of in the past, and that is just remain calm. This is a very volatile market environment. It's headline driven, and specifically tweet driven. This is not a time to be making major investment changes to your portfolio. from a top-down perspective, we would recommend that you take a look at your asset allocation, get yourself comfortable with the level of risk in your portfolio, and just be willing to ride out this volatility that we're seeing in the near term. Now, as far as specific things you could do, and let me just say, we have some things that we will express to you that we like, but these are not specific recommendations for you. We don't know your situation. But Jack, why don't you elaborate on some things that we do like right now?
Yeah, and I'd go back. The first thing I would say is you want your portfolio to be optimized, or you want to take advantage of diversification with the different slices of the pie or components of the asset allocation, so that not everything is moving in the same direction at the same time when you have these violent swings in the market. But, as we discussed, interest rates coming way down, there are interest rate sensitive stocks like utilities, for example. We would not be a fan of electric utilities, today, generally speaking. So we'd be trading out of things like that, or we'd be initiating purchases in things like with the news today. Okay, the concerns today are about global growth because this trade thing is so important. With the inversion of the yield curve, recession is coming, and we say, not so fast. If you take a contrarian stance, that's where you make money, not in the crowded trade. Now, you do need to be right when you take a contrarian stance too. But here's an example. As we said, stocks for income and bonds for speculation. How about this idea? Ford Motor Company. It's yielding 6.65% today. Trades under $9 a share. They missed earnings last time, but we think they're turning it around. It's the strongest U.S. automaker. We think we're going to see margin improvement in the next quarter. And you get 6.65% on the dividend yield, 3 times that of a long-dated U.S. Treasury. Or my favorite airline, Delta Airlines, knocked earnings and revenues out of the ballpark with their last release. They've taken advantage of the other airlines like Southwest that has 737 MAX Boeing aircraft that aren't going to be flying probably for another year. They've picked up some of Southwest routes. They figured out a way to divide the aircraft up into 4 different sections, starting with basic economy, Delta Comfort, the main cabin, and first class. If you buy a basic economy seat bill, you don't get your seat until the day before you fly, and yet unless you pay $25. If you hate middle seats, and so they've all the airlines have done this though. They've just completed rolling this out. So Delta's hitting it out of the park right now. We also like Facebook. They came in at 23% revenue and earnings growth last quarter. Yet the stock trades at about a market multiple, just slightly higher.
Headline risk, regulatory risk issues.
That's right. And we love what they're doing with their Libra currency, even though it's been poo-pooed by Trump tweets again. We think that brings legitimacy to it. So we also like natural resources in here. We love MLPs. These are, if you believe in American energy independence, for example, these are gas and liquid oil pipeline plays. How we move oil and gas across different places in the United States. These things have very nice dividend yields, more than twice that what you get from high quality bonds, and they're out of favor. You might have to wait a little while for this investment. So this would be an investment in buying something that perhaps very few people or nobody wants. This is where the greatest opportunity is. So would you like to add anything to that, Bill?
I think you covered the bases. But just to reiterate what Jack was saying, with these crowded trades, especially money flows going out of stocks in general and into bonds, it has made bonds, generally speaking, unattractive. The yields are too low. Demand has pushed up price on these issues, and so yields have come down. And the same with bond proxies like utility stocks. So flight to quality, that is a crowded trade, and I think that the herd is anticipating economic recession in the near term, and so they are leaving cyclical names, leaving many of the growth stock names, and that does present opportunities. That's basically what contrarian means, buying things that are out of favor.
That's exactly right. Well, Bill, I just realized it's 4:30 and our dogs are still inside. They're hungry. We need to get home and
I'm hungry.
feed Buddy and John. And but I'd like to wrap this up and just say, hey, we welcome you to write in, give us some questions, give us some comments as well if you'd like to. But we'd love to entertain some questions next Friday when we go again. And you agree? Anything else to add, Bill?
I do, and we did have one question that a viewer posed. Someone asked the question. Actually, it was more than a question, but the question was I using a coffee mug as a prop in an earlier video? I must confess, my coffee cup was empty.
Okay, well, we'll
Sorry about that.
I'll pour some coffee in there for you for the next one.
Thank you.
And we'll see you next Friday. Write in any questions you might have.
Have a great weekend.